Every year, billions of dollars are deployed into early-stage companies. But to understand why that capital flows the way it does, we have to look closely at the exact questions asked across the boardroom table. Venture capital relies heavily on pattern recognition. Investors sort through high uncertainty environments by leaning on their accumulated experience and looking for familiar success signals. This process creates an environment where evaluators trust their own gut instincts as objective measures of a company's viability. This chart compares identical venture metrics across two demographics. When the underlying business data is held constant, startups with female founders still receive a tiny fraction of the capital awarded to male-led ventures. When identical inputs reliably produce wildly unequal outputs, the evaluation system itself is broken. The discrepancy traces back to a psychological concept called regulatory focus theory. It describes how people subconsciously divide their thinking into two distinct tracks: securing a reward or avoiding a risk. When evaluating male founders, investors typically adopt a promotion track. They ask questions about acquiring customers, capturing market share, and maximizing growth, anchoring the entire conversation to the potential to win. The prevention track, applied to female founders, shifts the lens entirely. Questions move toward retaining customers, defending market share, and operating at break-even. The dialogue redirects toward defensive safety and risk mitigation. Because a founder must address the specific question they are asked, a defensive question forces a defensive answer. These diverging conversational tracks unconsciously engineer unequal investment outcomes before the pitch even finishes. Mitigating systemic bias relies on redesigning the structural architecture of the pitch, rather than appealing to individual awareness. Researchers from NYU Stern partnered with the investment organization Village Capital to test exactly how structural changes might affect capital allocation. In a controlled field experiment, a baseline group of investors evaluated startups using traditional, unstructured meetings. They were free to guide the conversation using their typical intuition. A separate treatment group operated under a new protocol. Their evaluation frameworks were modified to force systematic inquiries about both risk and reward, alongside a mandatory assessment of demonstrable progress across every founder. Standardizing these metrics removed the evaluator's ability to intuitively tailor questions based on a founder's identity. The critical shift in this new framework involved moving the central investor question from subjective potential to concrete progress. Investors were required to review tangible evidence of execution, examining traction and specific milestones achieved during the selection period, rather than relying on a subjective gut feeling. This chart plots evaluation scores before and after the change. Implementing this standardized inquiry process successfully eliminated the gender gap in investment outcomes. The trend eventually reversed. Female-led startups scored higher than their peers when judged strictly on dynamic, backward-looking evidence. Prioritizing objective evidence over subjective potential reorganizes the hierarchy of who is deemed capable of building a successful company. Structured systems and rigid processes repair flawed decision-making more effectively than individual behavioral training. Allocating capital always requires human judgment and an appetite for risk. Early-stage funding is inherently uncertain. But that judgment only becomes a reliable asset when it is constrained by a consistent framework and applied to an identical set of evidence. Entrepreneurs cannot rely on an investor's intuition to correctly interpret their company's abstract potential. You must construct your pitch around undeniable evidence of progress, anchoring the conversation to your execution rather than a subjective future. To structure that narrative, we created the VC Funding Blueprint Kit, linked in the description below. Priced at $497, the kit provides a complete structural toolset, a 16-slide pitch deck in Canva, an AI financial narrative engine, turning raw metrics into storytelling. You also get a 16-page instruction guide based on investor psychology, 16 VC-quality AI prompts, and a bonus high-ticket B2B sales deck. This includes full ownership, lifetime updates, and no recurring subscription fees. Better funding decisions start with better questions, but it is up to the founder to make the answers impossible to ignore.